Sure. Welcome everyone to tax prep session. This is a great time to do this session because the IRS will be opening up officially tax season on January 23rd. So this is a great time to really dive into tax prep for those who never filed taxes for the first time, for those who have, or those who need further help. This session will help you do that. Next slide, Daniela. So general housekeeping, this is going to be a brief rundown of taxes for 2023. So I want you to keep in mind as we move through each slide that every business is unique. There is no one size fits all. If you have specific help, need help, just seek a professional advice because I said every business is unique. And I'm going to talk about that a little bit more as we move through the presentation. So you're in the right place if you just started your business and you want to knock the 2023 tax season out the park, or you're an existing business and you want to make sure that you have been doing everything right, because a lot of times when you're working with a tax professional, CPA, or an accountant, that you want to make sure that you are on the same page with them and you make sure that you're understanding, because at the end of the day, once you sign that tax reform, you'll become liable for whatever's on that form, not the tax preparer. Next slide, Daniela. So disclaimer, as always, this information, this session is not intended to be legal or tax advice. It's for training purposes only. I advise you again, if you need specific information about your situation, you should seek a tax advisor, tax professional, or a tax attorney. I want to first tell you to give yourself a round of applause for taking the entrepreneurship leap. As you've already seen, if you've been in business from either from day one to 10 years later, it is not for the faint of heart. So I just always want you to give yourself flowers, to congratulate yourself, because it's not an easy task for somebody to take on, especially when it comes to this time of the year when it's doing taxes. Next slide, thank you. So facts. So believe it or not, every year small business owners overpay their income taxes by more than $2 billion. The overpayments are made because the business failed to take deductions that they were legally entitled to take. So that means that the IRS determined that a lot of times we're not taking full deductions. A lot of times because one, we don't know about these deductions. Two, we're kind of scared, like, can we really write this off? Or three, we don't really have any guidance on what we should be writing off on our taxes. So that's why they estimate about $2 billion is being left on the table. Next slide, Daniela. So I want to get into a brief introduction of what is the difference between business tax credits and business deductions. People don't understand the two. And so I kind of want to talk about a little bit of what is a tax credit and what is a deduction. So a tax credit is something that reduces your tax bill. So a tax deduction reduces your taxable income. Let me explain. So say you still have your 9-to-5 job and you have a W-2. Those are the credits that's going to reduce how much you owe. So once you start getting your taxes, they start putting your taxes and your information into the system. They start putting your income, your W-2, everything else, and say that you owe. So what a credit will do is will deduct the amount that you owe. And some examples of tax credits, I'm getting to a little bit later, is, for instance, everybody knows the big child tax credit or the earned income tax credit. A tax deduction reduces your taxable income. That means it will reduce not what you owe, but it will reduce the amount of your income. So let me give an example. Say you're reporting income of $50,000. So say you had a negative 12,000 in expenses. What that's going to do is now your income is going to be more like 38,000 versus 50,000. So that's how it reduces your taxable income. So remember, tax credit is going to reduce the amount that you owe, and the tax deduction is going to reduce the amount of your taxable income. So we're all going to be taxed at an income. And the tax bracket can really range between 22% and 32% based on your situation, based on if you have, are you single? Are you married? Married, filed, single, married, filed jointly, had a household. Those play a factor on your taxable tax bracket and how you're taxed by the IRS. Oops, go back. Thank you. Okay, next slide, Danielle. So tax credit. So here's some of the tax credits I talked about. So remember you all, for those who didn't get the stimulus, for whatever reason, it was an error, whatever like that, you got last year what they call recovery rebate credit. So if you didn't get that $1,400, then if you didn't get it, it's still not too late to get the recovery rebate credit. That was $1,400. So what that's going to do is that's going to limit, say if you owe $1,400, but then you applied that rebate credit, you're not going to be on that $1,400 anymore. Earned income tax credit, we talk about that. One of the things I like is the American Opportunity Credit and the Lifetime Learning Credit. That's if you have children in college or even yourself. There's a certain amount that you can deduct for learning that's automatic, is given to you. So think of tax credit as something that the government gives to you. You really didn't earn it, but they're giving it to you to help you with some tax burden. A tax deduction is things that is based on things that you spent that you want to try to use to reduce your income, which is like home office expenses, business mileage, charitable contributions. Next slide. So also, I want to talk about, as we go into continue our conversation on deductions, is that the IRS, for those who just started your business, meaning that you started your business sometime between January 1st last year to December 31st of last year, we're talking about 2022, you're able to deduct up to $10,000 in startup costs. So what that means is if it's the expenses prior to you start. People always ask me, Stephanie, when is my start date? How does the IRS determine my start date? I always tell my clients, think about the day when you actually done something legally to your business, meaning that if you got an LLC or you got your EIN number, anything prior to that can be I would say, is your startup. Once you officially make your business known, then you're really not in the startup deduction phase. So examples of, so basically, how do you take that 10,000? So what you take the 10,000 is you got business startup 5,000, organizational cost of 5,000. So I'm gonna go more into that in the next couple of slides, Daniela. Okay, so business startup costs. These are the costs that you get before you start the business. We all have them. Remember, it's always going to be different. It's not a one size fit all. So in this particular, I gave you a scenario. This is Tim. Say hi to Tim, everybody. Tim just started a business called Frosted. And so, as you know, when you're starting a bakery, any kind of bakery, you're going to have some expenses to get your business started, no matter what it is. So when you're starting a bakery, you're going to have you're going to need stuff. You're going to need pots, pans, scales, flour, all kind of things, website, aprons, all kind of marketing stuff. This can be considered up to your $5,000 in startup costs. So what if you didn't spend $5,000? That's okay. You're just going to deduct the amount that you spent. But what if you spent over $5,000 in this category? What the IRS allows you to do is what they call amortization, which allows you to do is you can roll over. So like say you end up spending $7,000 in this category. You can roll over to $3,000 for the next 15 years until it's been depleted. That is a good thing. So you don't have to sit there and worry like I didn't deduct all the 7,000. I'm short. No, you can roll it over. So make sure you keep that in mind, especially if you're flipping taxpayers. I know clients that they use different tax preparers every year. And so they're not going to know about the amortization unless they look at your previous tax returns to see if you have what they call a 187 carryover. That's on your schedule. That's on your tax return. Other than that, they're not going to know that you had a carryover. So make sure that if you do have a carryover, whoever's doing your taxes every year, you need to let them know, like, I still have $2,000 or $3,000 that I didn't use last year. And then you just keep rolling over until you fully got that deduction. And so, and again, those are the expenses that you can deduct as your startup. Next slide, Daniela. So before you start, so I gave you some examples. I talked about a little bit before, but before you start, I wanted to give you some visual examples of things that you can write off before you start it. Some people do customer service surveys or focus groups, market research expenses, product research, advertising. A lot of people who do Facebook ads or Google ads or Instagram ads, TikTok ads or LinkedIn ads, professional consulting fees. Maybe you paid a CPA in the beginning. Maybe you got an attorney. Maybe you got a business coach, things like that. Equipment fees. We talked about with a bakery, ovens, stoves, you need all that type of stuff. So think about equipment. If you are even doing bath and body products, you're going to need mixers and just things like that. Everybody's going to have different type of equipment. Some people like me, my equipment is computers, printers, earphones, things like that. Commercial lease. Some people have what they call a brick and mortar. So they're going to do a lease. If you want to start in a gas station or a car wash or a hair salon, that's considered in your commercial lease. And training. If you paid for some training, a lot of professions like realtors and things like that, you have to undergo some training. So all that is considered in your before you start. At the left column, you can't really see it too well, but it's an IRS publication called Business Expenses. So anything you want to know, IRS has publications for everything. And so if you want to learn more about before you start, go get the IRS Business Expenses publication, or you can email me and I can send it to you directly. Next slide, Daniela. So what is organizational costs? These are things that a lot of you already have paid, especially the ones that I have spoken to, a lot of my clients. The incorporation fees, when you got your LLC, whether it's your LLC, DBA, you got your BBL, which is the basic business license, or your HOP, which is the home occupation permit. Those things you can write off up to $5,000 in your organizational costs. Partnership filing fees, legal fees, accounting fees, business organization meetings. So these are things also $5,000. So what if you didn't spend all $5,000? That's okay. You just deduct what you can. Same thing applied here that applied to the startup cost is if you spend more than that. So if you spend like $7,000, don't forget that $2,000 you can roll over up to 15 years. So this is an example of, I gave you an example of the business startup cost, and now I'm giving you an example of organizational costs. Everybody's going to have similar, especially if you got the LLC, depending on the state, you pay $200, $175, Florida's $90, different things like that. We're all going to have incorporation fees, partnership fees, legal fees, accounting fees, and business organization meetings. Business organization meetings, like say if you and your partner went to lunch, Wendy's, and you talked about how to plan business planning meeting, those are considered business organization meeting. If you are S Corp, C Corp, it's part of your requirement to have meetings and minutes. So those things that you had prior to starting is what they consider your organizational costs. Next slide, Daniela. So I talked about the rule, business deduction rule, but I want to clarify a little bit more. So prior to the IRS guideline is that your expenses need to be ordinary and necessary for your business. And what does that mean? It means that it has to be ordinary, meaning that it's something that I have to do, right? It's ordinary because I have a specific niche, right? And so it's ordinary to me. So my business expenses are going to be different from Daniela's, and Daniela's expenses are going to be different from Carolyn's, and Carolyn's expenses are going to be different from Suzette's expenses, because we all have different type of industries, right? Necessary means I can't do it without, I can't run my business without these expenses. That makes it necessary. And so it has to be ordinary plus necessary. So you can't have a hair salon without having chairs, a shampoo bowl, a sink, towels. You can't have that stuff. And so that makes it necessary. Daniela? So common business style deductions. I want to give you just a few. Home office. So if you're in your home office right now, look around and see what's in your home office. Everything in that home office is deductible. You might say, well, Stephanie, I don't have a home office. I might just have a little desk in the corner. Good for you. Let me tell you why. The IRS doesn't specify what a home office is. It can be, as long as it's a dedicated space. I've had some clients that turn a closet into a home office. They just want a place. They have kids. They want a place for peace and quiet. They converted a closet. They have a desk in there, computer. They can shut the door. The IRS says, as long as it just has to be dedicated space. Some people work out of a dining room. That's okay. That's your dedicated space. And it's based on the IRS base your home office deduction on square footage. And so if you're using this like a second bedroom, the kids are gone, you're empty nester, you got a second bedroom. Typically a second bedroom is a 10 by 10 space, which is going to give you 100 square feet. So that's how you kind of do it. So when you think about your home office, just kind of think about your perimeter, how much square feet that you're using. Office supplies, home internet, cell phone. If you're using your cell phone, your personal cell phone to make business calls, guess what? You can write off a portion or all of your cell phone bills. You have to determine how much percentage that you're using for business and how much percentage you're using for personal. Education, utilities, mileage, and business insurance are some common business style deductions that I typically see business owners are making regularly. Daniela? Some business expenses you can't deduct. Unfortunately, I'm sorry. You paid into it, but unfortunately the IRS says you can't do it. And these are considered like political donations, hobby losses. Remember, so if you're a hobby versus business, when you're a hobby, you cannot write off deductions. But when you're a business, you can. So if you take a loss as a hobby, you cannot write off deductions. Entertainment expenses. A couple years ago, you used to be able to write off entertainment expenses. You used to see it, people taking their clients to ball games, to concerts, to dinner, things like, well, dinner you can still write off, but like concert tickets, baseball games, football games, those expenses you no longer can write off. There was a time when you could write it off, but now you can't write it off. Fines, penalties, say you had to pay a late fee or something like that, you can't write that off. And commuting costs. What that means is if you go to the same place every day as a business, they consider it as a commuting cost. But if I'm going to go meet Daniela for coffee to talk about business, and we don't do it often, it's not part of my regular commute, the expenses that I have with Daniela can be deductible. But if I was going to see Daniela every day as part of my job, I cannot write that off. Next slide. So it's quiz time. So I want everybody to go to the chat and we're going to test your knowledge. I want to see what you know so far and to see and explain a little bit more. So Daniela, first quiz. So I want you to just briefly put your answer in the chat. You get next slide, Daniela. Okay, so true or false, I can deduct breast augmentation or breast implants. True or false? Write your answers in the chat really quick. Let's write true or false. Okay, I see some false. Okay. Give a couple more seconds for people to participate. False, false, false. Okay. False. One more second. One more second. False. Okay. So Daniela, can you reveal the answer? Next slide.
You said yes.
Okay. The answer is true. So most everybody put false. Believe it or not, you can write off breast augmentation. Let me tell you why. So In the case versus Hess versus Commissioner, she was an exotic dancer. Her name was Chesty Love. And she kept getting breast augmentation because she said basically the bigger her breasts were, the bigger the tips. So she tried to write it off and they said, no, you can't do it. She challenged the IRS and said, basically what I was just telling you, she said the more her breasts got bigger, believe it or not, y'all, she went to a size 56 FF. I didn't know you could go that far. But she said the bigger her breasts were, the more money she made. So she challenged the IRS, and guess what? It was ordinary necessary for her business. She was able to substantiate the expense, and therefore she was allowed to write it off as a deduction. So thanks for based off of Chesty Love, if you have to do any cosmetic to your body that's going to help bring in more revenue, the IRS says it is deductible. I know it's unbelievable, but it's true. Next. Okay, let's get back to the true and false. Can you write off a car as a business expense? True or false? Write in the chat real quick. Okay, false, false, false. Somebody said, Daniela, their chat was disabled. A few people said.
I'll try to enable that.
Okay. False, false, false. Okay, false. Okay. So Daniela, can we reveal the thing? True, you can. Oh, wait a minute. The slides got messed up. Okay, go back to that one. I don't know what happened with the slide with that. So go back to the car one. So yes, you can write off a car as a business expense. Yes, you can. As long as it is ordinary necessary for your business. But let me give you a key out on this one. So the IRS recently in Spencer versus Commissioner, it was a case that they heard over in June. They said the business expense, you can get, anybody can get a car for your business. That's no problem with the IRS. But can you write off as an expense? And so over the summer, there was a ruling by the IRS court that stated that the business car expense has to be substantiated. And I talked about it earlier on. It's like you got to make it make sense. So if you say you have a daycare, would they allow you to write off a Bentley? No, probably not, because it's not ordinary say for your business. Now, if you had a daycare and you bought like a passenger van, yes, you can write off the expense. It has to be substantiated. And so, but then the IRS also said that if you use a personal guarantee to buy that that car, meaning that somehow you put your social security number now and that car is showing up on your personal credit report, the IRS looks at it as a personal debt, not a business debt. So keep that in mind. And we can talk about that another time, more into like writing off a business expense. But yes, you can write off a car as a business expense if you substantiate it and it's ordinary necessary for your business. Next slide. Just skip through this one, Daniela. Okay. Can you deduct body oil? True or false? I'll give you some time to write that off, to write it down. I got some true. I got some true. Okay. 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 So I got some true. Danielle, can you reveal the answer? Possibly. Let me tell you why. So Ware versus the Commissioner. So Ware was a bodybuilder, and this is an I learned. I didn't know that bodybuilders a requirement that they be oiled up to show their muscles, but he was using gallons of body oil every year. The IRS first said no, you cannot do it. And Corey Ware was like, not only was he a professional bodybuilder, he modeled in like Muscle magazine. And the more, so like to show the definition of the muscles, body oil is a good way of showing that. And that's part of some of the requirements when you're doing the scoring in bodybuilding. So he challenged, at first they said, no, you cannot write it off. They ended up removing the deduction. He ended up owing because he went over the deficiency amount. And the IRS, he came in and positioned himself to say, hey, this is a requirement. He even showed evidence that it's in the judging criteria. Because of Coy versus Ware versus the commissioner, body oil can be a write-off if it is necessary for your business. Next slide. Okay, go back to the next slide. Go back one more, Daniela. Okay, so the whole purpose of right here. So the whole purpose of this is I wanted you to see that when I talk about ordinary necessary, some of you all said false. You were thinking false because you were thinking probably like your business, but remember that it's ordinary necessary for your business. And so flour typically would not be considered a business deduction because we could typically use it for personal. We could use it to bake, to fry, to make stuff. But if you're a baker or things like that, you're going to need flour, right? So you got to remember, again, all expenses are going to be ordinary necessary for your business. You're going to have what they call the burden of proof to prove that it's an expense. And so when you're working with your CPA, your tax accountant, or your bookkeeper to prepare for this, start thinking about that. What expenses are necessary, ordinary for your business? What can if I didn't have this, can I still run my business? Just kind of thinking like that. Because I'm going to give you a little secret. A lot of times when you go talk to a tax person, they're not going to walk through this with you. They're going to expect you to come there prepared with your list of expenses. They're not going to sit there and be like, oh, Tanisha, you're missing stuff. No, this is why this training is so important. So now you can start thinking about, you know what? I need to think about what expenses that I have paid that are necessary for my business so I can write it off. Because that's not their job. If you want them to do that, they're going to charge you more per hour to do that. So that's why I want you to be armed and informed so that when you're ready to do your taxes this year, you can sit down thinking about expenses that are ordinary necessary to your business. Next slide. One of the things I want to talk about too is R&D credit. A lot of times business owners do not use this. They just don't use it. And it's like anytime you do anything research and development, you can write that off. If you're experimenting, I've had clients this week talking about they were experimenting on different products that help with eczema or emphysema, things like that. If you're spending money on any research or you're experimenting, things like that, I have clients, I always recommend them, if they're going to be doing any type of product that you put in your body and your mouth, I always recommend they go through product testing, send it to a lab. And so if you're doing that could be expense that you can write off under R&D credit. That's a credit you can get. But again, so you look at the how you can use it. Your gross receipts cannot be more than $5 million. It's a 5-year tax period. And you cannot be read as a tax exempt organization, meaning you can't be a nonprofit. So that's why I always encourage my clients to go get their products tested, because one, it's helpful for them to make medicinal claims, but two, they can then try to use this R&D credit when they're filing their taxes. Okay, this is very important. Know your deadline. There's several different deadlines that apply to every different type of business. So basically, if you have any 1099s, and this is important because February 1 is coming up front. If you paid anybody over $600 last year, you need to file a 1099 to the IRS by February 1st. And what you're going to do is you're just going to report that you say you paid me $600. So you're going to report to the IRS that you paid me, Stephanie Magnus, $600. So you're going to give a copy of the 1099 to me, and then you're going to file a 1099 NEC to the IRS, right? There's a lot of websites out there that you can do it. You do 1099, I think it's like file1099.com. It's going to cost like $12. But keep in mind, if you pay me over $600, you're going to have to file a 1099. So that way I can claim it as income on my taxes. Now, if you miss the February deadline, let me just tell you something. The IRS charges you $50 late fee for each person every month. So like it's $50 every 30 days that you didn't turn it in. And so the late fee is very great, where you could just have paid that $12.99 to a company to do it. So remind you, think about anybody you paid money over last year, over $600, that they should get a 1099 by February 1st. So March 16th, if you're a partnership or multi-member LLC or SOC Corp, your tax filing date is due March 16th. The reason why is that you don't file these returns with your regular return. These are called separate entities. And so you're either going to do a 1065 or you're going to do 1120 form. It's separate from what you would do with your 1040. Now, everybody else is going to do April 15th when you file your regular personal tax return. With your personal tax return, you're going to include what they call a Schedule C in there. The Schedule C is labeled profit and loss. And this is how you file your business tax return if you're a sole proprietor or you are a LLC, okay? So this is what you're going to file. So if you're a nonprofit, you're going to file your 990 on May 15th. So it's important not to take these deadlines lightly, because at some point you're going to be maybe charged a late fee. Even if you owe, even if you do it in June or July and you owe, they're going to still charge you interest from April. So you want to kind of try to make sure that you know your deadlines. Even if you file an extension, they usually give you a 6-month extension to October. If you owe, they're going to still go back to April as far as interest owed. So keep that in mind. And then it's like, 5% tax interest every month that you're late. So think about if you even do it in October and it was due in April, they're going to go back and charge you those late fees. Daniela? Okay, so you want to pinpoint the right tax forms. I talked about it in the previous slide. So if you are a sole proprietor, and let me make it clear, if you're an LLC, per the IRS, you are still a sole proprietor. A LLC is a disregarded entity with the IRS, meaning an LLC is just a state law on your state legislation. So every state has what they call Limited Liability Act. That's what that falls under. It has nothing to do with the federal, nothing to do with the IRS. With the IRS, you're either a sole proprietor, you're a partnership, you're an SOC Corp, or you're a nonprofit. So you will file a Schedule C. So how do you provide your income? You do what they call a 1099. And so that's how you would support your income as a sole proprietor. If you are a corporation, you'll file 1120. If you are a partnership or multi-member LLC, you would do a form 1065 with a K1 form. Next slide, Daniela. Okay, so I talked about nonprofit. If you're a nonprofit, it's a 990. And some people will still keep their LLC, but elected to be charged as a S Corp. And how they do it, so they can pay themselves a salary. And so if you're an S Corp election, you would file a form 8832 to be classified as an S Corp election, so that way you can pay yourself. Because remember, when you're an LLC, you're not allowed to pay yourself because they call it double taxation. You're already going to be charged self-employment tax. You don't want to have to then turn around and pay income tax as well. Next slide. And I can clarify in the Q&A section. I'm just kind of giving a rundown, but if you want me to clarify anything, drop your questions in the Q&A and I can elaborate a little bit more. So what you want to do now is, if you have not prepared for your tax season, you want to start pulling your financial records, any profit and loss statement. So if you use like QuickBooks, Wave, any type of financial system, they should be able to give you your profit and loss statement with a click of a button. Or if you have a bookkeeper, they should be able to give it to you. You want to also start looking at invoices and receipts. And let me tell you something. The biggest mistake I see is people's not keeping their receipts. They're just going to go off of their business bank statement and their business credit card statement. But I wanted you to tell you that when it comes to an audit, bank and credit card statements is not going to suffice in the audit, because the auditor is not going to know what you bought. If you look at a bank statement, it's just going to say Walmart. They're not going to know what you bought from Walmart. For all they know, you could have bought groceries, you could have bought toys, They don't know that it doesn't say that you bought a computer or iPhone or things like that, or a desk or lamp from Walmart. You're just gonna say Walmart. So you're gonna have to keep your receipts. And it's also the receipts are required for compliance. You're supposed to keep your receipts for 3 years, right? Now, anything, I'm gonna give you a secret. Anything under $75, they're really not gonna care about. It's anything over $75. But that's only when it comes to food, meals, gas, and mileage. Anything else, any other expenses, you're gonna have to justify it. Any payroll or vendor payments, you have to report it. We talked about the 1099. So you want to make sure if that people are giving you the right forms as well as you giving other people the right forms. Bank and credit card statements, I talked about it a lot. They're only good for reconciling your expenses of the month, but using it as receipts or for your expenses deductions can cause you some headache down the line that you don't want. So always keep your receipts. There's different ways to do it. But yes, so next slide, Daniela. So now let's talk about receipts. In the chat, quickly drop how you currently keep your receipts. Is it on your device? Is it some sort of box, purse, pocket? What I mean by box too, I have clients that say their first drawer of the first drawer in their drawer system has boxes. Some people tell me, has receipts. Some people tell me in their kitchen they have a junk drawer. You know, everybody has that junk drawer. It's full of receipts. So how do you currently keep your receipts? You can drop it in the chat really quick. Okay. All righty. So next slide, Daniela. So what is the best way to keep receipts? For me, I would say device, because you don't risk fading or losing it. You can always save it to the cloud. There's different software out there you can use to keep receipts, or you can just snap use your camera and snap the picture and then you go, right? Reason why I don't like the other ones, because as you know, like how many times you have gone to Walmart and 2 days later you can't read the receipt? Is because some people use they call thermal printing. With me it's going to fade, it's going to smear, or lighting hits it. And so the best way to always keep your receipts is either scan them, put them on your device. Don't put them in your pocket. Don't put them in your glove compartment, because if they can't read it, or doing an audit, they can't read it, what's going to happen? They're going to remove that deduction and you might end up owing. And so try to get in best practice of doing this, of trying to take a picture of your receipt, scan it. They have scanned right now. Epson even have a, I don't know if some of y'all have seen this Shaquille O'Neal commercial where he's scanning receipts. Epson makes a good receipt scanner as well. It's gonna cost you about $300 or $400, but there are receipt scanners. Or your phone is free, just like you taking selfies and you doing TikToks, whatever. Just take a picture of your receipt and keep it moving. Okay, yellow, next slide. Okay, I already told you the answer for this. I kind of skipped over it, but the answer is if you lose your receipt, your bank and credit card statements is good enough to the IRS. Daniela, move on. And it's false, because as I talked about it, you have the burden of proof. A statement does not show what you actually purchased. For all we know, you could bought a pool table. So no receipt could end in reversal of a deduction, which means you can owe the IRS back. Next slide, Daniela. However, this is something they don't tell you. It's a thing called the Cohen rule. And I'm giving you a little secret gem here. So basically, Cohen challenged the Circuit Court of Appeals. He went above the IRS. After they told him no, he went above and he appealed the decision to the Second Circuit Court of Appeals. Cohen was a traveling artist. And like a lot of us, I'm guilty of this too. I go to the gas station, I press for the receipt, I get off the street and I forget the receipt, but I'm not going to go back and get it. So same thing happens to him when you travel a lot. That's when you really lose receipts. And so he challenged that. He was like, it's hard. I'm on the road all the time. I'm gone 20 days out of a month. He challenged it. So this is how the Cohen rule came about. So I'm going to tell you about the Cohen rule. you can try to recreate the receipt, right? And so I recommend Googling lost receipt affidavit. Some of you all are doing it now in your current 9 to 5. You know, you may have to do that when you lose a can't find a receipt. But under the Cohan rule, you can try to recreate the receipt, but it only applies to meals, mileage, gas, travel. You cannot try to recreate an iPad receipt unless you go to Apple directly. They may be able to get the receipt for you. But if you lost any of those type of receipts, you can do it under the Cohan rule is try to recreate it. Now, this way you can use your bank and credit card statements and say, okay, I know on February 4th, I went to Wendy's and I'm going to put on them as detailed as I can. That's going to suffice in the audit. And you can challenge you can say the Cohan rule. So a lot of times they don't tell you these things, but I just gave you a gem that's going to help you if you lose any of those type of receipts. Daniela? So I talked about before, how long should you keep receipts? 3 years. So there's a publication, 583, that it's a good read because it breaks down everything I'm talking about today. And it's, the IRS puts it out. So 3 years to keep the receipts. After 3 years, you can toss them away. And the reason why is 3 years because you can only be audited for 3 years unless they suspect fraud. So typically an audit can only go back 3 years. And so, unless it's fraud. So that's why it's a 3-year rule for receipts because the auditing is 3 years past. Daniela? This is a good best practice because a lot of times, if your memory is like my memory, I'm not gonna remember what I did. So on the left-hand side, I'm gonna show you a receipt that I did. So I had lunch with Sabrina and it was a PR meeting. This is what you want to kind of do. So if you're just giving your receipts to a bookkeeper or a virtual assistant, this is going to help them too. So you can also write on there, this is best practice. Write on the receipt if it was just yourself, it's with yourself. What was the purpose of the meeting? And what was the purpose of the travel? That way, when you give it to your bookkeeper or virtual assistant or your accountant, they can already see, oh, this is going to go under the PR category. Also, if you're in an audit, a lot of times you're not going to remember what happened 3 years ago. But if you wrote on that receipt, it might trickle memory. So when the auditor is like, what's this? It's $29. Oh, I remember. I had a meeting with Sabrina. We talked about PR for the business. And they're gonna keep on going. So try to get into the best processes. And also it needs to be an itemized bill. So on the left, you see that it breaks down what was bought. You know, we both had a fish sandwich, chicken sandwich. We had fries. On the right-hand side is what I typically see as a tax preparer as well, is a person just keeps the credit part. It doesn't itemize what you bought. So try to keep in mind, try to keep the itemized part. Just having the slip that says you paid $29, again, here's another thing where the IRS is telling you, I don't know what you bought. We know you went to Main Street Restaurant, but we don't know what you bought because it doesn't tell you. It just tells you use Discover card, $29. Unless you kind of write on it. Sometimes I'm guilty of that. I grabbed the wrong one. I grabbed the credit thing and I immediately tried to go and write on it what it was. Or I might go back to the waiter or waitress and say, hey, I'm gonna need my itemized copy back. Daniela? So again, always be prepared to prove your deduction. Next slide. So as you all probably heard, they had made this new rule last year that if you use these third-party companies, Cash App, Venmo, Zelle, PayPal, that they were gonna, anything over $600, they was gonna send you a 1099-K. Guess what? They temporarily suspended that. Congress did because they said that this was a burden among small businesses. So now, what does it mean for you all? It means that the requirement has been suspended. Doesn't mean that they still can't do it. It's just saying that now they're not bound by regulation to do it. So they still may do it. I know for one, Square is going to do it regardless. They just do it regardless. They've been doing it before the rule had changed. But keep in mind, it's not a requirement for them to do it, but they still can do it. So keep in mind when you're doing your tax returns, see if they're going to log into your Cash App, log into these, and see if there is a 1099 that has been generated. Next slide. So upcoming changes to the tax law. So basically in December, the IRS upped the standard mileage rate, which is now going to be 65.5 cents per mile. So if you're creating mileage, meaning that you're going on business travel, you're meeting business, you're doing business runs, business errands, you can deduct your mileage. And now they have increased it by 3 cents per mile. So now it's 65.5 cents per mile. So keep that in mind when you're doing your spreadsheet to get to your CPA or accountant or tax preparer, that you need to base it on the new mileage rate. Next slide. So I always say avoid common landmines. Remember, it's business, not personal. You want to always remember your business expense. If it's personal, you cannot write it off. Set your structure from the start. So get prepared, like know what your structure is. If you're an LLC, I ran down some of the requirements, some of the forms you need to know. If you're a partnership, I ran that down. If you're SOC Corp. So set your structure from the start. This is going to help you make your tax season go smoother and smoother and smoother every year, where you're going to become the tax pro. And that when you go meet with your tax person, you're already going to be on it and quick, because you already know what you're going to need to be doing. And pay your payroll tax properly. People always ask me, should I pay quarterly or annually? It's really up to you. Just keep in mind that it's always going to be interest attached to it. And so some people just want to prepay their taxes. What happens if you pay over? Of course, you'll get it in a refund. But if you are paying payroll taxes, that means that you have employees, or if you're an SOC Corp or you have the S Corp election that you're paying yourself, make sure that you pay your payroll taxes properly, because the fines and fees are very heavy on this subject. Next one, Daniela. So I want to kind of really quickly go over the Schedule C cheat sheet, because most of our clients are LLCs. And so what you want to keep in mind as you're moving toward this tax season is start thinking about your goods and services that you have that you made a profit from. That's going to be your income. So under the Schedule C, the first section is going to be your profit. That's anything you made, even owner's contribution. Even if you put money into your business, that's considered income. You mark it as a contribution. So anything, goods and services, anything that made you money that you put into your bank account is your income. That's going to be your profit. The next section of a Schedule C is going to be your loss. Your loss. It's not really a loss, but it was money that you had to put out from what you gained to buying stuff. So for instance, if you bought a computer, you bought food, office supplies, printer, all those are expenses. And what you're going to do is get to that bottom number, which is line 31, which is going to be your net profit. So always remember, it's going to be your income minus expenses equal your net profit. So if your net profit is a negative, that's okay. Because what's going to happen is that net expenses is going to reflect on your 1040. So if you're making $80,000, if you still have your 9 to 5, you're making $80,000 a year again. And if you have a negative 10,000, you're going to be taxed at 70,000 versus 80. But let's reverse it. Your line 31, you got 10,000. That 10,000 is going to be added to that 80,000. Now you're going to be taxed at 90,000 versus 80. This is why I say it's so important to try to get as much deductions as possible, unless you're really trying to show an income. And that's fine too, but just keep in mind, whatever's on line 31, it's going to have an effect on your 1040 adjusted income line. So you want to get in best practice of keeping a monthly cash flow forecast. So that way, that's how you stay organized. If you do a month by month, I don't want you to be running around with your head covered like a chicken, trying to get this done before the tax season, before April 15th, unless you're going to file an extension. So a monthly cash flow forecast is going to show you what you brought in every month and what you spent out every month. to get that bottom line. So you see where my arrow is. So if you look at this cash flow statement, it shows $108,000. But guess what? I had over $112,000 of expenses. So I'm currently going to be in the hole. That's how you can know. You can always catch stuff before you get to December to try to fix some things before December come around. Because once December 31st come around, you can't really make any adjustments because that's the kind of cutoff for 2023, which was December 31st. So this I'm going to go over this really quickly because I want to really get into Q&A. Danielle, you can kind of go through this fast. I want to give you examples of things that you can write off in your home office. Next slide. These are things you can write when you're traveling. I always say when you go to the gas station, sit there and reflect. What can I write off? Gas, fuel. I have insurance on my car. I have lease payments. Ignore the mileage. I told you the mileage increased. So I got to reflect this in the upcoming PowerPoint. Repairs, tune-up, and tires. I will suggest keep a mileage log in your car if you constantly on business travel for a lot. Like if you're a realtor, you're a painter, you a plumber, whatever, you need to keep a mileage log in your car. It's no set mileage log from the IRS. They just want a detailed reporting of your mileage in order to claim it. Next slide. When you're traveling, plane ticket, baggage fees. Next slide, Daniela. Hotel, Airbnb, they treat them the same. A lot of times people say, I stay in the Airbnb. They treat Airbnb the same as a hotel expenses. So that bill you get from the Hilton at the end of your stay can be a deduction. This is the one thing people don't know, tips for services. Anytime you tip on business, you can write that off. So if I slip you, you open up the cab, I'll give you $5. You open my luggage, I give you $5. So keep a record of your tips because tips are one thing the IRS says that you can write off. And a lot of times people don't know this. But yes, anytime you tip somebody on business travel, just keep a log so you can write it off. Know these resources. I talked about these resources in previous slides. If you need a copy of that, you can just always email me and then I can send them to you. But you want to know, it breaks down everything I'm talking about. Record keeping, business expenses, how to use your home office. Next slide. You survive. I know it was a lot of information. I was trying to get through it as fast as I can because I really wanted to get into the Q&A, but you did survive. Next slide. And we're at the end. So Daniela, we can actually open up for Q&A.
Yes. So I have it on. I know we've had a few questions since the beginning, so I'm just gonna go through the first one. I have a question about kind of LLCs versus corporations. When I guess Melina, you can ask your question live if you want to, or you can ask it in chat. Okay. I was able to enable the chat as well. Yes, she has her hands raised. Melina, you can unmute and ask your question.
She asked her question. So she says, we have one car. Can my husband and I write off the same car for different businesses? This is a really good question, Melina. So yes, you can. You're going to have to write off what percentage you use for business and what percentage you use for personal, for both. So take 100%. And so firstly, define how much percent you use for business. So say 50-50. So did your husband use 25% and use 25%? Because here's the thing is because you're married, I'm assuming you're filing jointly. So you're going to be using the same tax return anyway. You're going to have different Schedule Cs because of different businesses. So what you're going to really have to do is figure out your percentage for business use and his percentage for business use. That's how it works. And then what percentage for personal? So maybe you say, it's 50-50. So out of that 50%, how much 50% did you use? And then how much 50% that he used? I hope that makes sense. For example, You may have used the vehicle 30% for business, but he may use it for 20%, and the other 50% was personal. I hope that makes sense. But yes, you can use, even if you have one car, you can both write it off for businesses because you all use a different percentage of the vehicle for your business.
Thank you, Stephanie.
Oh, wait a minute. Hold on real quick. That's for mileage. Now we're talking about the purchase of a vehicle, right? That's a little bit different. So I don't know her situation, Daniela. I would need to learn more about it, because if you're trying to write the purchase of the vehicle, was it purchased jointly, or was it purchased under one person? So I need a little bit more before, if that's part of the question, I will need a little bit more.
And Melina, you can always email us. You can email Stephanie at Legit My Business, or you can just email me, or go to our website and schedule a one-on-one session with Stephanie and kind of go through that as well. I will put the email in the chat shortly. Stacy asks, will we be able to rewatch these even for a short time? Definitely, I'll be sending the videos, the webinar video to you guys after this session. Lizzie asks, are all these quarterly dates for any expenses or income from 2022, or is it ongoing in 2023?
The dates are ongoing. It's going to change based on a holiday. So if something is due on a holiday, it's going to be due the next day. But typically, when the IRS, the dates are the same. They don't change unless if it falls on a holiday. It could be, or if it falls on a Saturday, it could be Tuesday, because typically, if a holiday falls on a Saturday, Monday becomes the holiday, then it's Tuesday. But typically, it's the same date, depending on if it's a holiday or not.
Thank you. Thank you, Stephanie. Katie asks, what if you started your company in the same year you worked for another company and you would receive a W-2 from them? Do you need to file a 1040 and an 8832 form?
So I'm assuming if she's filing an 8832, she has the S-Corp election. You still have to file a 1040 because you have a W-2. If you don't file a 1040 and you get W-2, you're gonna get that letter from the IRS saying that you failed to file to claim income. So if you got a W-2, you're still gonna file a 1040 regardless, because 1040 is your personal. Now, if you're doing an 8832, again, I'm assuming that you are S-Corp because you mentioned that form. You still got to file that separately, and that's going to be the 1120 S form that you're going to fill out. But I'm not knowing the total situation here. I don't know what business entity that Katie has, but yes, to answer the first part, a W-2, you're gonna have to fill out a 1040, because if not, the W-2 is gonna be reflected on your wage and income transcript with the IRS, which you can always pull up every July. And if that shows up, trust and believe, you'll get that white envelope with that window on it, and from the IRS, they're gonna say, hey, Katie, you failed to report income. Guess what? We're going to include it, and they're gonna give you their estimation and telling you got 2 weeks to respond. So you don't want that issue. So remember, if you have a W-2, that company has reported their income to the IRS. That means you're gonna have to do that, file that 1040.
Thank you, Stephanie. Hi, Lucas asked, please clarify if the car being written off should be in company names.
Okay, hey Kia, how are you? So that means, okay, so if the car does not have to be in the company name to be written off, but it has to be 100% business use, right? But keep in mind, I talked about personal guarantee. So if you personally guarantee that car, you can't write it off at all. That means if you use your social security number and that car is being reported on your personal, what I mean by Equifax, Experian, or TransUnion, the IRS made a ruling a year or so ago that says that that's considered a personal guarantee, and in their eyes, it's personal. So, but again, as I showed you in the true and false, anything can be challenged, right? As long as you can substantiate and say, hey, yes, it's in my business name. So you're going to have the burden of proof to show that that car was 100% for business. Meaning you have to show like, okay, maybe some travel receipts. Maybe you might have had in your personal name, but when you went to Jiffy Lube, you put your business name down for the receipt. So again, as I proved to you in previous slides, that anything can be challenged with the IRS. You have the burden of proof. So even though you can say it's my personal name, you're going to have to unequivocally show 100% that car was 100% for the business. And then again, you have the burden of proof to pull that. So you got to pull all kind of tricks out of the hat to pull that off. But keep that in mind if it's not in your business name. I hope that makes sense.
Thank you. We have a question again from Katie. It says you only have to send vendor 1099 forms if you paid them $600 or more, correct?
That's correct. Yes. $600 or more. This is for your vendor payment. So like if you paid a virtual assistant, a bookkeeper, you're supposed to send them a 1099. Hopefully you first send them a W-9 first, because you need to collect their information. So if you have not gotten the W-9, you need to send it to them now. So you can hire you, because you're gonna need to get the business name and the EIN number. So typically what you want to do, best practice, is that if you have anybody that you're going to pay over $600, bookkeeper, assistant, virtual assistant, exactly whatever, you make sure you get the W-9 first, because that W-9 is going to be able to capture their business name and their EIN number, or they're going to elect to use their social security number. You need to collect 2 of those things. So hopefully you have that. And if you don't, in order to do a 1099, you have to go back to that vendor and say, hey, I need your information.
Next question from Maggie. Can you deduct/write off the expenses charged by services like Square, the percentage of each transaction?
Oh no, you can write so if using Square for totally business, that percentage, that 2.29 or whatever it is, you write the whole thing off. If you only using Square for business, that's 100% deduction. That doesn't make sense. Now, if you're using Square with other people, no, you got to figure out what percentage is for business. But yes, interest, bank charges, monthly maintenance fees, typically all that's 100%. You write the whole percent down. If it's on a business account. So if you're using Square for total 100% business, that on that reporting, you'll find out like, okay, I gave Square $35 last year in transaction fees. Then when you go to file your taxes, you put $35 down.
Great. Next question for Melina, okay. And I'm sorry we are over. Well, we went a little bit over, but I just want to make sure we answer a few of these questions. What is more beneficial, LLC or Corp, a single member LLC person? She is. In other words, at what point is it more financially beneficial for me to switch over to Corp?
Well, again, this is something is based on your needs and what your goals are. One thing I can tell you was, as an LLC, you can't take a salary, right? If you want to take a salary, you would definitely want to move to a corporation status. That's the first part. So a lot of people want to show income, because it's really hard to get things like buy real estate or buy a car if you don't have income. If not, they're gonna want to see like 6 months of bank statements and things like that. So it depends on your goals or what you're trying to do in the future. Now, at what point is it financially beneficial for you to switch to a core? Well, it's up to you. I would write down the pros and cons of both. One of the things about being a corporation you got to know is it's more paperwork. You're expected to have shareholders. You're expected to have board meetings, a corporation kit. There's a lot to do with it. When with the LLC, you have more autonomy how you spend the money. As an LLC, you can always just draw out your money. No questions asked. You can take out when you want to, right? But a corporation, you have to account for everything. It's a little bit more heavy on the requirements, even on the state side. Even if you look at the state legislation. So LLC is under the Limited Liability Act, but an S corp is under subchapter S of the Corporation Act. And under that, it tells you record keeping, the minutes. You got to have a certain amount of shareholders. So I tell people, it's really up to you and how much work you want to do. we have some amazing companies out here that are still LLC. Amazon, Sony, they're all LLCs. A lot of time, and what they do is they do what they call series LLCs. They have different divisions under there, but it really depends on you. I can tell you now, if you're not good with record keeping, you're not good with compliance, you don't want to do minutes, shareholder meetings, then you may not want to go to the S corporation. Now, if you want to pay yourself a salary and things like that, you may move to the S corp. So it really depends on your individual needs and goals for your business.
Thank you, Stephanie. Next question is, are there any free resources where I can generate a 1099 for vendors, or do you know if that service is included in QuickBooks?
It's included in QuickBooks. It's included in Square. Square Payroll does it. I mentioned earlier, there's a system called, if you Google, it's like 1099forms.com. It does it. It charges you $12 per vendor or something like that. There are different options you can use. You can actually do it manually if you want, whereas you go to irs.com, get the form. It's a PDF fillable, and then you can mail it to the IRS. That's free. You just pay for postage. I don't know your budget to recommend one thing or other. You said free. So for me, free meaning it's to do it by paper. Is to print, go to irs.com, and get the 1099 form, fill it out, and just mail it to the IRS. That's the free version. Or the cheaper than QuickBooks I mentioned is called, I think it's like 1099forms.com or something like that. And they charge like $12 per vendor. And they actually, for the $12, they send the form to the IRS for you as well. So those are just some different options for you. But yes, QuickBooks, Wave, Xero, all of them have that functionality to do it, but you're gonna have to pay for
it. Great, thank you, Stephanie. Next question, and I'm just gonna keep running over. I have a single member LLC. I would have a W-2 for the job for the most of 2022, but it ended in September. What is it that you mentioned about income? I didn't quite catch it. I asked, since my LLC will be my sole source of income in 2023.
Hey, Carolyn. Carolyn's one of my clients. Hey, Carolyn. Carolyn, so basically, you're gonna have to file that W-2 because you got, remember, I talked about, somebody else asked that question above. A W-2 is going to be reported to the IRS. So you are going to have to claim that as income, right? And so, but for next year, Carolyn, you and I can work on that in one of our sessions, is to talk about, the self-reporting. So when you're a strict full-time entrepreneur, you have to self-report on your Schedule C. And so the first line of your 1040 is going to be blank, because the first line of 1040 says W-2. Once you become full entrepreneur, you don't worry about that. It's like in the middle of 1040 is when you input your self-employment income. So you're still going to have to do a 1040 even with full-time entrepreneur. It's just that the line one would ask for a W-2 income. It's going to be blank. You're only going to fill in the line that says other income.
Great. Next question is, if I have a residential rental business and working also part-time on K-12 teaching, how do I do my taxes? Is there a counselor I can talk to?
Yes, it's anonymous. I don't know who this person is. You can schedule, Danielle, can you provide the information?
Yes, so I did put on our website on the chat. And so you can just register at dcwbc.org, and you can schedule a session with Stephanie, and she can walk you through that. Next question is, if I started my business in January 2023, do I start paying quarterly on February 1st, 2023 or March 16 of this year?
So Lizzie, this is a really, hey Lizzie, this is a really good question, because you just started your business in January 2023. So what are you estimating? I would say, I always tell my clients, wait into the second quarter to see how well you're doing, because if you just started your business, you don't know what you're really going to be making in, right? And so this is kind of a tough situation because you just started and we only in 18 days into January. Unless you have a really good planned out budget, I would say that, but I don't understand like, what you mean by paying your quarterly taxes because you haven't made any money. And are you basing your quarterly taxes on assumed income coming in? So Lizzie, in our session, we can talk a little bit. You schedule a session. Let's talk a little bit more about this because I want to understand what your goal is for 2023 is.
Great. Next question from Tanisha is, I used a Shopify vendor located in Canada. When I send them a W-9 to fill out to prepare the 1099, they inform me that they don't fill out W-9s because they are not a U.S. company.
That's correct. That's correct.
What form should I guess?
Yeah. So you don't. So basically, you're going to have to. You just have to record it as a business expense. So what you would do is the amount of money you pay for the Shopify vendor, you would just record it as a business expense. They're not by law required to claim it as income. So what you want to do is under inventory, under category inventories, where you want to drop this in. And so because it's an international, we don't have an international trade agreement with Canada, anything like that. So what you want to do is just file it as an expense under your expenses. And then I will create a chart of account. If you don't have one, called inventory. And then drop it there because I'm assuming if you say Shopify vendor, it's for inventory.
Great. Last two questions. I'm not quite sure what this person asked. W-2 or 1040.
I got it. So yeah. So basically, if you have a W-2, you got to file a 1040. Because if you don't, every July, they get the wage and income report to the IRS. And what happens is October comes, if they find out you in October, they start sending these called statutory notice of deficiency. And so what's going to happen is because businesses really technically have until July to turn in all income reports to the IRS. That's why if you look at your wage and earning transfer report right now, it's blank. And so if somebody reports a W-2 to the IRS and you didn't report it, trust and believe in October, you're going to get this letter, this statutory letter, CP 575 notice from the IRS that says, hey, you failed to file the W-2. So always remember, if you get a W-2, you're going to have to file a 1040 because that means the other party has already sent the income to the IRS.
Thank you, Stephanie. Last question. Who is responsible if the LLC is being sued? Is it the owner or the LLC?
The LLC. Now, let me backtrack that quick, Daniela, real quick.
Mm-hmm.
It depends. Let me tell you why. It depends if you have done your proper maintenance on your LLC. Meaning is, if your LLC is in good standing, you had a separate bank account, you treat the LLC like a business, then the LLC is getting sued. You're going to be summoned as a officer of the LLC, or member of the LLC, but technically it's going to be the LLC. Now, let me tell you what happens. If your LLC, at the time you're being sued and you were not in good standing with your LLC, you as the owner will be sued because you cannot flash the LLC badge because it was not in good standing. So keep that in mind, that if you did not do your annual fee, for instance, in Maryland, other states, it's every year. DC is every 2 years after the first year. So if your LLC is not in good standing, you as the owner are going to be sued because we wasn't in good standing. So they can't sue the LLC. That's why they call it limited liability, because there's a thin line we have to draw, right? And so if your LLC is not in good standing, then you're fine. But they go to file a lawsuit and they realize that you're not in good standing, your LLC means it's not existing anymore. You're not even an LLC because you're not in good standing. Then they can come out to the owner.
Good. That was all the questions we had for today.
Okay.
Again, if you just want to follow up with Stephanie, you want a one-on-one session with her, to kind of go through some of these, you can go to our website at dcwbc.org. You register for a session. If you're having any issues, you can just email me at ddjiogan@ncrc.org, or you can email us at info@dcwbc.org, and we will be able to follow up with you as well. Thank you so much for sticking out with us, or like staying here with us. Thank you, Stephanie, for so much information, and I really look forward to people reaching out to you as well to kind of get more, knowledge, tools, resources as it relates to tax planning. Thank you so much, and have a
let me just real quick. I just want to say thank you all. And then, I'm sick. That's why my nose looked like this. So I really wanted to make sure I get this done because tax season is going to open up next week. And so I didn't want to miss this. But yes, so I just want y'all, I hope y'all got a lot of it. I know I ran through it really quick because I'm not really feeling good, but I didn't want you all to miss the opportunity to have this session.
Thank you, Stephanie.
Bye-bye.
Have a wonderful day, everyone. Bye-bye.
Bye-bye.